Welcome to this explainer. Today, we're looking way past the standard ticker symbols and diving straight into a comprehensive financial checkup of an absolute Wall Street powerhouse, Goldman Sachs. Whether you're a seasoned pro or just starting to size up bank stocks, getting a true read on a financial titan means you really have to look under the hood. We're not just glancing at today's stock price. We're going to run a full diagnostic on the company's valuation, their growth, the dividends, and their overall financial health directly from the raw data.
Let's kick things off with the elephant in the room, a massive question derived straight from the numbers. It's literally the question every investor wants answered when they're staring down a blue-chip stock. Is the market missing something huge? Because when we ran the discounted cash flow and earnings metrics for Goldman, the output was genuinely surprising, and it totally sets the stage for our entire analysis today.
Get this. When you look at the calculated fair value price based on their earnings, it sits at an eye-popping $4,051.96. Let that sink in for a second. Now, compare that to its last close of just over $937. On paper, that suggests a massive 76.86% margin of safety. It looks like an absolute steal. But, as we all know in finance, when a number is this huge, it usually means we need to dig a lot deeper to see if reality actually matches the math.
So, do the underlying metrics justify this wild valuation, or is there a catch? Let's run the numbers through our scorecard. We're going to hit Goldman by the numbers, unpack the stock valuation, check out historic returns and growth, dive into dividends, assess their financial health, and finally, deliver the verdict.
All right, Section 1. Goldman Sachs by the numbers.
We are dealing with a true titan here, sporting a $276 billion market cap. Over the trailing 12 months, they've pulled in nearly $128 billion in revenue, which translates to over $17 billion in net income. These aren't just big numbers. They represent massive global operations, sprawling trading desks, major investment banking fees, and asset management on a scale that very few companies could even dream of.
Moving right along to Section 2, unpacking the stock valuation.
Let's see how much of a premium you're actually paying today to own a slice of those massive earnings. To really grasp this, we anchor on the PE ratio. You know the drill. It's essentially the price tag the market puts on one single dollar of Goldman's profit. And right now, it's telling a pretty fascinating story.
Now here is where things get super interesting. The stock is currently trading at a PE ratio of 17.14, but compare that to its recent history. It's sitting over 9% higher than its 3-year average of 15.71. In fact, if we look back even further to the 5-year average, the current PE is sitting more than 19% higher.
The bottom line here is that compared to its own recent past, the stock is noticeably more expensive right now. And it's not just the price-to-earnings ratio either. The data shows this premium exists pretty much across the board. The price-to-sales ratio is up nearly 35% over its 3-year average, and the price-to-book ratio is up 32%. So the market is definitely pricing Goldman at a distinct premium today compared to just a few short years ago.
Okay, Section 3. Historic returns and growth.
So, are investors actually getting rewarded for paying those higher multiples? The short answer seems to be yes, absolutely. Over a 10-year horizon, Goldman Sachs has delivered an absolute mammoth 590% return to its shareholders. That means if you had bought and held over the last decade, you'd have watched your initial investment multiply nearly 6 times over. It is a staggering figure that really highlights their ability to generate serious wealth over the long haul.
But hey, we all know growth is rarely a straight line, right? Especially in the financial sector, owning a bank stock requires an iron stomach. Those massive recent gains, like a 52% return in 2024 and an incredible 56% in 2025, well, they were preceded by some pretty sharp swings. Look back at 2018, where the stock dropped by over 33%, or 2022, which saw nearly an 8% decline. You've really got to be prepared to weather the macroeconomic storms if you want to capture those upside rallies.
Despite the yearly volatility we just talked about, there's an incredibly strong longer-term compounded annual growth rate at play here. And what really stands out is that their growth hasn't just been steady, it's actually been accelerating. Their 10-year CAGR is a very solid 21.25%. But over the last 3 years, that annual growth rate has skyrocketed to over 43%. The momentum recently is just undeniably powerful.
Let's pivot to Section 4, dividends and shareholder value.
Because let's face it, for a lot of investors, a bank stock isn't just about price appreciation, it's all about the income.
The payout ratio right now sits at 29.6%. This means just under a third of their net income goes straight into your pocket as a dividend, while the remaining 70.4% stays locked in the bank's vault to fuel further operations, invest in tech, or build capital reserves. This is generally considered a super healthy conservative payout ratio. It gives you income, but leaves plenty of room for the company to absorb any economic shocks without having to slash that dividend.
And talk about consistency, Goldman Sachs boasts 15 consecutive years of dividend hikes. Now, while the current yield is sitting at a relatively modest 1.92%, which, to be fair, is partly just because the stock price itself has risen so rapidly, look at that trailing 12-month dividend growth rate, almost 50%. They are aggressively ramping up the cash they return to their long-term holders.
All right, time for Section 5, Checking Financial Health.
You can't do a physical without checking the cholesterol, right? And for a bank, that means digging into debt and liquidity. A current ratio of 0.30 and a debt-to-equity ratio of 10.65 might look incredibly alarming to a casual observer. If this were a retail company or a tech startup, alarm bells would be ringing loud and clear. But context is everything here. These heavy debt loads and low traditional liquidity ratios are actually quite structural for major financial institutions. Banks use leverage as their primary tool to make money, borrowing short to lend long.
But we still need to weigh that against their own historical baselines. While high leverage is normal for them, the current leverage of 10.65 is elevated by over 17% compared to its own 3-year average of 9.07. That's a trend worth keeping an eye on. It basically tells us that Goldman is currently utilizing more debt relative to its equity than it typically has in the recent past, which does slightly dial up the overall risk profile.
Couple that increased leverage with a deeply negative free cash flow yield of minus 17.07%, and, well, it paints a pretty aggressive picture. It means they are actively deploying their cash right now, not just sitting on it. In the context of a huge bank, this usually points to expanding their loan books, investing heavily in market making or other core operations, rather than generating a massive surplus of unencumbered cash.
Which brings us to Section 6, the final verdict.
When we put all the pieces of this puzzle together, we're left with a really fascinating tension. On the one hand, we've got a stock delivering monstrous historical returns, fantastic dividend growth, and an on-paper fair value calculation that is just off the charts. But on the flip side, it's currently trading at a premium PE ratio compared to its recent history, while carrying elevated debt and negative free cash flow yields. It's essentially a high-performing engine that is running extremely hot right now. So as we wrap up this explainer, I want to leave you with this to chew on. Does that massive 76.86% margin of safety discount signal the absolute opportunity of a lifetime? Or is the scorecard warning us that the heavy leverage and premium valuation require a healthy dose of caution before jumping in? The numbers have laid out the story. What happens next is up to you. Thanks for joining me for this financial physical, and keep asking the hard questions about your investments.